You have, of course, heard of the S&P 500. I'm sure you own some of it right now in your portfolio, but here's something that most people don't understand. There are actually two very different ways of owning the same 500 companies, the same S&P 500. And right now, in 2026, that difference matters more than it has in a long time. I've got that full breakdown, that more coming up. The S&P 500, it's the stock market. Some people used to call the Dow the stock market, but the Dow Jones Industrial Average, that's just 30 companies, and they're from a lot of different industries. These days, and I would say probably for the past 10 years or so, the S&P 500 is widely considered to be the stock market. It's what most people mean when they say, oh, I'm just going to invest in the market. They mean the S&P 500. And it's been a fantastic long-term investment instrument. But here's what a lot of people don't realize. The S&P 500 is not actually 500 equally sized companies. It never has been. And right now, it's more top-heavy than it's been in decades. Today, we're going to talk about the S&P 500, how it actually works, what cap-weighted means, and what it looks like when you flip that around and go to equally weighted instead. Not to tell you that one way is better than the other, it just depends on your situation and your financial goals, but so that you understand exactly what you own and why it matters. Okay, so the traditional S&P 500, the one most people own through something like SPY or VOO or IVV, those are exchange traded funds, or the Fidelity 500 index, that's a mutual fund. It's called a cap-weighted index, a market capitalization weighted, okay? That means the bigger the company, the bigger the slice of the pie. A company's weight in the index is based on its market capitalization, meaning the total value of all the shares outstanding. So a company worth, say, $3 trillion gets a much, much bigger piece of the pie than a company, say, worth $30 billion, which is still a big company, but compared to $3 trillion, not even close. Even if they're both in the S&P 500, very different weightings based on their overall market cap. Here's what that looks like in practice right now. I know you've heard of the Mag 7, but let's zoom out a little bit and just talk about the 10 largest companies. You can see them on the screen right now. Apple, Microsoft, Nvidia, Alphabet, Meta, Tesla. The top 10 out of 500. Well, 7 of those top 10 make up about 32%. You can see the top 10 make up about 39% of the entire S&P 500. So when you own the S&P 500, you really are owning a fund where almost 4 out of every $10 is concentrated in just 10 companies. Now, is that bad? Not necessarily. This is actually how cap weighted is supposed to work, and it tends to be a pretty good deal when markets are growing. The biggest winners get a bigger share. And for years, especially the last decade, this has worked beautifully. The mega cap tech companies, they keep growing, their share of the index keeps growing, and as they grow, every dollar you had in that cap-weighted S&P 500 continued to grow with them. That's the beauty of the cap-weighted index. It's self-reinforcing on the way up. But there's another version of the exact same index. It's the same 500 companies, the same S&P 500, but instead of weighting them by size, you give every single company the same weight. That's it. So Apple gets about 0.2% of all of your money, of that entire portfolio, not based on its size, but just based on 1/500th. So does a mid-size industrial company that you've probably never heard of. Same weight as Apple. There's an exchange-traded fund that tracks this approach. The ticker is RSP. I'm not recommending that, but just if you wanted to go check it out, it's the Invesco S&P 500 equally weighted ETF. It's the same 500 companies, very different ride. So what does equally weighted investing actually do? Well, structurally, a few things. First, it dramatically reduces your concentration in these mega caps or these top 10 companies. Remember, they made up about 39% of the overall cap-weighted index, but in the equally weighted version, those same 10 companies equal about 2% versus 39%. That is a massive difference. Second, equally weighted gives you more exposure to the middle of the market. And again, not saying this is a good thing or a bad thing, I'm just saying it gives you more. Not small cap, not micro cap, those mid-sized companies that are still considered large, part of the S&P 500. So industrials, financials, healthcare, energy, you get much more meaningful representation instead of just a rounding error to those. And third, and this is the one that I find really interesting, equally weighted has a built-in discipline built into it, right? Every quarter, the equally weighted index rebalances. It trims what ran up the most and it buys back whatever has lagged. It trims the winners and adds the laggers, forcing a, sort of sell high and buy low sort of approach. That's the opposite of how cap weighted works, right? Cap weighting says, give me more of what's been working, right? I want a bigger exposure to the biggest winners. Equally weighted says, not so fast, let's keep things balanced. So now the obvious practical question, which one is better? Well, you've got to decide which one's right for you based on your investment goals and your risk tolerance. Cap-weighted wins when a handful of very large companies are dominating the market. Think the past 10 years, or really even think 2023, 24, 25. The AI boom. NVIDIA up several 100%. Microsoft, Apple, Alphabet, all pushing higher. That concentration has been a massive tailwind for cap-weighted indices. Over that stretch, the cap-weighted S&P 500 ETFs have significantly outperformed the equal-weighted RSP. Now that said, when the winds shift, an equally weighted approach could be much better. Coming out of the tech bubble, for example, equally weighted did a lot better. If you look at the 10-year time period from 2003 to 2013, equally weighted significantly outperformed the cap-weighted. Why? Because that was a period when market leadership was more broadly distributed. The big tech companies weren't all running up at once like they kind of have been right now. In the middle of the market, those mid-sized industrials, financials, energy companies, they were all pulling their weight. And we've actually seen that equally weighted approach start to win recently as well. As recently as 2022, which was a pretty rough year for the overall market. Equally weighted, yes, still negative, but it held up significantly better than the cap-weighted index. Through July of 2026, equally weighting was ahead again, outperforming the market cap-weighted. Why? Some of this was due to some trimming and some uncertainty around the AI mega cap thesis and some concerns about that. Plus, broad market participation was increasing as well. So what does this mean for you? I want to be very clear about something. I like the cap-weighted S&P 500. For long-term investors, it has delivered outstanding results. It's low cost, it's simple, and it captures the growth of the largest American companies. I'm not here to tell you to abandon it. I personally like it. The fact that the better a company performs, the greater the weighting of the S&P 500, I actually like that approach. But with market concentration at these levels, I want you to understand what you own and why, and if it makes sense for you to shift your approach or adjust your approach, I wanted you to do so being very aware and not making an emotional decision. Some investors choose a blend of the two, so holding both the cap-weighted, maybe as the core, the long term, but then adding in the equally weighted as part of the mix during times maybe like this when concentration really gets to a high point. The point is, this isn't a one-size-fits-all conversation. It's a conversation that needs to happen within the context of your comprehensive financial plan working with your CFP. So work with your CFP on that. If you don't have a CFP on your team, you can contact one on my team. Find us online, Korhorn.com. That's Korhorn with K, wisemoneyshow.com. You can find us there as well, or give us a call, 574-247-5898. All right, there you have it. Go out and take your next wise step in your financial life.